This morning with earnings in focus right now and Netflix really kicking off the tech component of that. There's going to be a big question about whether the biggest winners can continue to climb. Eddie Ghabour, CEO of Key Advisors Wealth Management, joins us as part of our opening bell coverage. Eddie, good to see you. First of all, what do you make of the fact that we have seen this record run for stocks?
So luckily, we've been expecting this since the tariffs were basically reversed, and we started to take a look at what the underlying fundamentals were going to be going into the back half of this year. And we think markets are going to continue to go significantly higher over the next 12 months. And really, when you take a look at the entire globe, one of the biggest things that I think is being overlooked by the average investor is the amount of liquidity that's going to be going into the markets globally. You have central banks around the world are going to be easing monetary policy over the next 12 months, and you've seen that. The markets in the EU, China's markets catch fire. We're at all-time highs. So it's really a Goldilocks market right now. And lastly, there's still a tremendous amount of people doubting this rally. Big hedge funds still shorting the market. And as long as you have that component, you're not going to get to that over-exuberant market yet. So there's a lot of cash on the sideline that I think is going to ultimately be forced to buy this market and take us to really much, much higher over the next 12 months.
Interesting. I mean, care to put a guesstimate on what that sort of bullish sentiment means in terms of overall returns for the stock market?
So we believe the S&P will get to about 7,500 before we have to worry about a potential bear market sometime in 2026. And that's, again, a lot of it is a function of liquidity and how positioning is. And really, the other component is the U.S., we're not even close to a recession, and there's still a lot of people continue to wait for the recession. And none of the data that we're seeing is supporting that. So there's been some softening, but when you look at the labor market, you look at consumers continuing to be resilient. Wages are actually increasing at levels we haven't seen in a long time. Inflation, PPI came out, was the lowest since September 2024. There's a lot of really good things happening before we even get to the liquidity component that's going to start to hit the tape probably in the fourth quarter of this year.
From looser monetary policy, as you mentioned earlier. Okay, so 7,500, that's give or take about 20% of potential upside. When you look at the different components of the stock market, where's the wind taking you? Like, what are the kinds of sectors that you think end up being the biggest beneficiaries from that?
We still think tech will be the leader just because of how big of a percentage they are of the overall market. And we've been really overweight tech, but now we've started to broaden out. And I think investors can further diversify out. We've been increasing and started a position in financials. Financials, due to the deregulation and non-recession, should thrive in this type of market. And also material stocks. You know, EU just announced some major defense spending increases. We think you'll see that trend happen around the globe, and that should help materials as well too do well. So we're starting to really broaden out our portfolio. And lastly, probably the most hated area that we're in right now, we're going to look to increase the small caps. They've really underperformed the last 3 years, and we think they're going to really catch a bid and be one of the big winners over the next 12 months.
Okay, lots to chew on there. I guess since we're talking sector themes, you mentioned financials. You also mentioned that additional spending tied to defense. Are there any examples of ways to play that, you think, for the average investor?
So for the average investor on the material side, we would do the ETF XLB. And on the financials, we've played it with two ways. One is JP Morgan. We think Jamie Dimon's one of the best CEOs on the planet, so we want to be best of breed there, as well as the ETF, which is XLF. So we find those ETFs as great ways for everyday investors to participate in this historic rally because you don't see markets like this very often, so you want to get as much as you can while it's still good.
Interesting. And then getting back to the tech component, which you mentioned, you still see upside for that group. What would be some of the ways you might suggest investing in tech right now?
Semiconductors, in our opinion, will continue to lead. SMH is an ETF that we own, and everyday investors can get into that. And as well as NVIDIA. You know, we've owned NVIDIA. It's a best of breed name. And again, when you look at the math of how much NVIDIA is important to this market, it's really hard to have a market go to new highs without that stock being one of the bigger performers. And it kind of goes back to owning that best of breed. So owning that individual name with the ETF as well as the QQQ. It's been just on a race up, and that's a way to own the Mag 7 and still be able to, again, participate without having to buy the individual name.